Hello, this is Sean Copeland, Chairman and CEO of Regent Bank, and welcome to another edition of Regent Elevate. Today we are moving into the second of a two-part series on private investing. Not investing in the stock market, but investing into privately held companies or real estate or debt instruments that are not publicly traded on the stock market. So let's jump in. Before I do, I just want to remind you real quick, you can get all the Regent Elevate videos, this one and all last year, at our website, regent.bank. Click on Resources, click on Regent Elevate, and you have them all there at your fingertips. So I hope you enjoy them. Back to private investing, there are really four things that you're going to look at when you are looking at buying an existing company or piece of real estate, okay? And these are all very important. Some are more widely understood than others, but let's just dig in. First and foremost, you're going to look at ownership issues. You have to make sure that you understand how the company or property are owned. You have to make sure that you know how to properly document your ownership whenever you are buying into that company. An attorney can help you do that. You're going to want to make sure that you are not inheriting any prior legal or financial issues of that company. Here's why it's so important. If you buy the stock of a privately held company, you inherit all of those warts. Any lawsuits that are out there, any liens that are out there against the company, any taxes that are owed, that also applies to real estate. So you want to make sure that you are getting that property or company free and clear. Very, very important. Number two, you want to look at the financial piece. This one we all know about, but let me tell you some tricks of the trade here. You want to get 3 years, at least 3 years of financial information for the company, or if it is an income producing real estate property, same thing. You want to get 3 years of financials just so you can trend it. That's enough time. You can look at fluctuations and that type of thing. There are really, in addition to just looking at the numbers and making sure you understand the numbers, which your CPA or banker can help you with, you're also going to want to look at several things. Number one, you want to look at their clients. If you're buying a company and they only have one big client and that client changes their mind and decides to leave and fire you, you got nothing. You have just bought nothing. So you want to make sure that you have a widely spread clientele, that they have been with you for a while, that they are stable, that you are not overly reliant or concentrated in one or a few particular clients. And if you are, you want to make sure that somehow you can get comfortable that they're not going to leave and that they are going to stay with you for the long haul. Number two, competitors. You're going to want to look at your competition. How do you fit in? Are they strong financially or weak financially? Are they good strategically or not? How does their brand compare to yours? What are the risks that they could come in and take market share away from you? Or do you see potential that you could go take market share away from them? You just truly want to understand the strengths and disadvantages you have compared to your competitors. Number three, you need to look at the industry. You're going to have a great company, but if the industry is deteriorating and going down over time, no matter what you do, how much market share you gain, you're not going to make it. So you want to make sure you're not getting into an industry that is hurt by technology or by regulation or things that could really, really change the industry in general. And then finally, as I mentioned earlier, you want to look at ongoing capital needs of that company. A lot of time people will buy a company and they have plenty of money for the purchase price or they get it financed or whatever, and the company looks really good on paper, and the company does. The company makes money. But what they don't factor in is the capital needed to continually grow and maintain the company. Maybe you need new equipment. Maybe there are other issues you have with the company scaling. So you want to make sure that you have plenty of capital, not only to buy the company, but to grow it in the future. Third, you want to look at people issues. How deep is your team? How stable are they? Are they all going to leave when the company is sold? How would you replace them? What is the knowledge base that you are tapping into? And so you want to just make sure that ideally, you would buy a company that is performing well, all the people would stay, it would continue performing as good or better than it has after you buy it, and everything is great. The problem is that's not always how it works. So you want to make sure that you understand the people associated with the business, and then finally, you need to understand control issues. Now this is very, very important. A lot of times people don't understand this. When you buy into a company, if you buy all of the company, this isn't a big issue. But if you are a partial owner, you're buying 20 or 30% of an LLC or a certain number of units or whatever, you truly need to understand your rights as a shareholder. There should be a shareholder agreement or bylaws in place that says how we're going to function as partners together. If one of us wants to leave, how do we handle that buyout? If additional capital is needed, how is that determined? How much do we have to kick in? Who determines how much capital is needed? There's just many, how do we buy and sell stock if we want to buy? Who can we buy and sell to? So there's many things to consider when you're buying into a company from an ownership perspective. So as you can see, this is a very involved process, but I assure you that if done well, there are tremendous opportunities in the private investment market. I hope this helps you. We appreciate you joining us for another edition of Regent Elevate, and we'll see you next week. Thank you.